The AI boom isn't slowing down, it's mutating. While headlines were busy cheering record profits and shiny product demos, five signals buried deep inside big tech's latest earnings just flipped the script on everything we thought we knew. These aren't hype cycles. They are the hidden gears driving the next trillion-dollar phase of AI. Today, we're decoding the numbers Wall Street missed. And trust me, they are not what you expect. Welcome back to AlphaForge AI, where LLMs read the footnotes analysts overlook. So, big tech's latest earnings just dropped, and while Wall Street is busy with the headline numbers, the real story is getting almost completely overlooked. Buried deep in the Q3 and Q4 2025 financial reports from giants like Microsoft, Google, Meta, Amazon, and AMD is a shocking new reality about the AI boom that almost no one is talking about. A lot of the comfortable narratives are breaking down. The assumptions that have driven the market for 2 years are being challenged by cold, hard data. What if I told you the undisputed king of AI hardware might be losing its spot as the most important company to watch? Or that the biggest fear hanging over Google's business was just publicly debunked by their own balance sheet? In this video, we are not just scratching the surface. We're going deep into the numbers to break down the 5 most stunning AI earnings insights that are about to change how you see this whole technological revolution. And we're starting with the most provocative one, a shift that could redefine the entire chip space. The case for why AMD, not NVIDIA, might just be the single most important bellwether for the AI boom right now. Let's get into it. For the last 3 years, whenever you heard AI hardware, you thought of one company, right? NVIDIA. Its stock price became a proxy for the entire AI boom. Its earnings calls were practically national holidays for investors. Every single percentage point of data center growth was torn apart for signs of the AI revolution's health. NVIDIA was the bellwether, the one sheep with a bell that told you where the entire flock was headed. But this latest earnings season just handed that bell to a new player, and its name is AMD. Now, hold on. This doesn't mean NVIDIA's reign is over. That would be absurd. But focusing only on NVIDIA now is like trying to understand a hurricane by just looking at its eye. You miss the sheer scale and power of the storm. AMD's recent performance gives us a much clearer picture of the true size and staying power of the AI hardware boom. So let's get into the numbers from their Q3 2025 report. AMD posted a stunning 36% year-over-year revenue increase, hitting a record $9.2 billion. But the mind-blowing part is where that growth came from. Their data center revenue shot up 22% year-over-year to $4.3 billion. This was driven by overwhelming demand for their ePYC processors and, crucially, their AMD Instinct MI350 series GPUs. For years, the story we all heard was that AMD was a distant second in the AI race at best, just trying to catch up. These numbers tell a completely different story. Hyperscalers, the giants like Microsoft, Meta, and Oracle, aren't just buying from NVIDIA anymore. They are aggressively buying AMD chips to power their own AI platforms. So, why is this a huge deal? It signals a fundamental market shift. First, it proves the demand for AI compute is so colossal, so utterly gargantuan, that one supplier can't possibly handle it all. The market isn't a zero-sum game. It's an exploding pie with more than enough for everyone to get a huge slice. This de-risks the entire AI investment thesis, which for a while looked dangerously dependent on a single company. Second, it shows the AI hardware market is maturing. Cloud giants want to diversify their supply chains, create price competition, and use different chips for different AI jobs. AMD is positioning itself as a strategic top-tier choice next to NVIDIA. It's like Pepsi, but for GPUs. We are seeing this play out with their server CPUs. Adoption of their 5th gen ePYC processors was so fast it accounted for nearly half of their ePYC revenue this quarter. This shows they're gaining serious trust and market share. And the story doesn't stop there. AMD's client segment, the chips in our laptops and desktops, saw revenue jump 46% to a record $2.8 billion. This is being driven by a massive PC refresh cycle, with new computers sold on the promise of built-in AI, powered by chips like AMD's Ryzen AI processors. So here's the bottom line. When you combine world-eating demand in data centers with a new wave of AI-powered consumer devices, AMD's success becomes a proxy for the entire end-to-end AI revolution. Watching their data center numbers tells you about the health of the cloud. Watching their client numbers tells you about AI adoption on your desk. They've become the ultimate bellwether, not for the hype, but for the real widespread deployment of artificial intelligence. While Wall Street was watching one stock, the real signal was coming from its biggest competitor. And that signal doesn't stop at hardware, because next we are heading into a story that completely flips one of the most common AI fears on its head. For over a year, there's been this dark cloud hanging over Google. The fear was simple but huge: AI cannibalization. The theory went something like this. As Google integrates its powerful Gemini AI to give direct answers in search, people will stop clicking on the blue links. If they don't click, the multi-$100 billion ad business that underpins Alphabet's entire empire would crumble. Pundits predicted AI would eat Google's core business alive. It was a terrifying narrative. And according to Google's latest Q3 2025 earnings report, it was spectacularly wrong. The numbers that came out didn't just ease those fears, they blew them out of the water. Alphabet announced its first ever quarter with over $100 billion in revenue. Total revenue was up 16% year over year to $102 billion. But here's the kicker. Far from cannibalizing ads, AI seems to be supercharging them. Search and advertising revenues were up a massive 15% to $56.6 billion. CEO Sundar Pichai said directly that new AI overviews in search are actually driving an increase in total query growth. How's that possible? It's counterintuitive but powerful. AI isn't just answering simple questions. It's letting people ask more complex ones that lead them deeper into discovery and ultimately commerce. But the story gets even better when you look at Google's other big engine, Google Cloud. This was the part of the business that was supposed to benefit from AI, but nobody predicted this kind of explosion. Google Cloud revenue surged an incredible 34% year over year to $15.2 billion. It didn't just beat expectations, it smashed them, signaling Google is becoming a true AI powerhouse. The most mind-boggling number of all, the Google Cloud backlog. The amount of contracted future business jumped by $49 billion in a single quarter, hitting a total of $155 billion. This isn't just normal growth. It's a tidal wave of enterprise demand for Google's AI infrastructure, its custom TPU chips, and its Gemini models. Companies are signing massive multi-year deals, locking themselves into the Google ecosystem to build their own AI futures. The key takeaway here is that AI isn't a zero-sum game inside Google. It's a force multiplier. The AI in search makes the cloud platform more attractive, and the data from the cloud platform makes the AI in search even smarter. It's a virtuous cycle, a perfect feedback loop for innovation and profit. For months, the market priced in the risk that Google's golden goose was about to get cooked by its own AI. But the Q3 earnings were a victory lap. They proved the goose is not only safe, but is now laying golden eggs in two different nests. The great cannibalization myth is dead. Google's actually feeding off its own AI. But just as one tech giant proves the model works, another is starting to feel the cost of keeping it alive. We'll get to that in just about a moment. Ever since they partnered with OpenAI, Microsoft has basically owned the AI story. They were the first movers, the evangelists, the ones who brought generative AI to the masses with Copilot and Azure. Their stock became a Wall Street darling, and CEO Satya Nadella was hailed as the visionary who had perfectly positioned the company for the future. Every earnings call felt like a victory lap. And on the surface, this quarter looked like more of the same. The numbers were spectacular. Microsoft's intelligent cloud revenue surged 21% to $26.8 billion. Within that, the all-important Azure and other cloud services revenue jumped an astonishing 33%, with a full 16 percentage points of that growth coming directly from AI services. These are the numbers of a company firing on all cylinders. And yet, right after the earnings release, the stock actually took a little dip. Why? Because for the first time, investors started to see the cracks in Microsoft's impenetrable AI armor. The problem wasn't demand. Demand is insatiable. The problem is the staggering difficulty and cost of meeting that demand. Buried in the reports were whispers of Azure outages and capacity constraints. When you promise the world access to the most advanced AI, your infrastructure has to be flawless, and the strain is starting to show. The second concern was a slightly cautious tone from management, a subtle acknowledgement of the monumental challenge ahead. Think about it like this. For the past year, Microsoft has had the fastest engine in the race, the OpenAI models. Everyone wants it. But what this earnings report revealed is that putting that engine into a car that millions of people can drive reliably all at once is an epic engineering challenge. You can have the best engine, but if your chassis, tires, and cooling system, your infrastructure basically, can't handle the power, you're going to have problems. This was reflected in the numbers. While cloud revenue soared, Microsoft's cloud gross margins actually dipped slightly, which was directly attributed to the massive capital required to scale its AI infrastructure. Microsoft spent a jaw-dropping $21.4 billion on capital expenditures in a single quarter, and has signaled that spending will keep increasing. And this is the secret truth of the AI boom that Wall Street is just starting to wake up to. Leading the AI revolution isn't just about having the best code. It's a brutal, expensive, and logistically nightmarish race to build the physical infrastructure to support it. It's about securing land, pouring concrete for data centers, getting enough power, and filling those buildings with hundreds of thousands of hyper-expensive processors. Bottom line, Microsoft is still in an incredibly strong position. But this quarter was the first reality check. It was a reminder that the AI revolution isn't a clean digital affair. It's a gritty, physical, and astronomically expensive undertaking. So, these cracks in the armor, they aren't a sign of failure. They're a sign of the incredible stress that comes with trying to build the future. And it's a warning that the path to AI dominance will be paved not just with brilliant code, but with billions of dollars in cold, hard infrastructure. All right, quick pause. We've hit the new AI bellwether, busted the Google myth, and uncovered the hidden challenges facing Microsoft. Now, we're getting into what the mainstream headlines are totally missing. If you're finding this analysis valuable and want to stay ahead of the curve, do me a favor and hit that subscribe button. It tells my overlord, the algorithm, you appreciate this kind of deep dive content and you won't miss our future investigations. Next up, we're talking about the single biggest driver of this entire boom, a $1 trillion spending spree that changes everything. There's an old saying from the gold rush. When everyone is digging for gold, it's a good time to be in the shovel business. In the great AI gold rush of 2025, The shovels are the data centers, the servers, and the chips that form the backbone of all artificial intelligence. And this earnings season revealed that we are in the middle of the biggest, most expensive shovel buying spree in human history. Nowhere was this clearer than in Meta's Q3 report. On the surface, the results look messy because of their one-time tax charge of 16 billion. But looking past that, Mark Zuckerberg made a statement that should have been the headline everywhere. He said that in the race to build AI capacity, he would prefer to overbuild rather than underbuild. And he backed that up with a staggering spending increase. Translation: honey, I bought another data center. Jokes aside though, Meta raised its capital expenditure forecast for 2025 to between 70 and 72 billion. To put that in perspective, that's more than the annual GDP of some countries. But here's the mind-blowing part. They then signaled that spending in 2026 would be notably larger. We could be looking at a single company spending close to 100 billion in a single year, just on infrastructure. At first, Wall Street panicked. Meta stock dropped, with investors worried about the ballooning costs. But they were totally missing the point. This isn't reckless spending. It's a declaration of war. It's Meta signaling that AI infrastructure isn't a cost. It's an existential bet on the future. And here's the key takeaway. Meta isn't doing this alone. This isn't one company on a shopping spree. It's a coordinated, industry-wide arms race. At the same time, Alphabet boosted its 2025 capex plans to between 91 billion and 93 billion. Microsoft's spending continues to climb every quarter, with projections for next year blowing past all previous records. And Amazon has said its spending will also increase significantly. When you add it all up, the four largest tech companies are on track to spend over 400 billion on capital expenditures in the coming year. This isn't a trend. It's a seismic shift in how capital is being allocated on a global scale. This is the single most important and most overlooked insight from this earnings season. This is why companies like Nvidia and AMD are seeing explosive growth. It's not happening in a vacuum. It's a direct result of this unprecedented infrastructure build-up. Meta, Google, Microsoft, and Amazon are placing a collective trillion-dollar bet that AI is the foundation of all future technology. Zuckerberg explained it perfectly. He said that if superintelligence arrives sooner than expected, they will be perfectly positioned. And if it takes longer, they'll simply use the massive amount of extra computing power to accelerate their core business. It's a bet with a limited downside and a potentially infinite upside. Wall Street saw a hit to short-term profits, but the real story is that the tech giants are collectively underwriting the entire AI revolution. The numbers are hard to comprehend, but the implication is simple. The AI boom is not a bubble built on just hype. It's a construction project of historic proportions, funded by the deepest pockets in the world. And just when you think the race can't get any bigger, it does. Because one company's been quietly winning from the shadows, and almost nobody noticed. For most of the AI craze, Amazon has been the quiet one in the room. While Microsoft was making headlines with OpenAI and Google was showing off Gemini, Amazon's cloud division, AWS, was seen by some as trailing in the AI race. They were viewed as a powerful but slower incumbent. This earnings season, however, that idea got shattered by one shocking detail. In their Q3 earnings call, Amazon revealed that their custom AI chip business, centered on their Trainium 2 chips, saw demand grow by an unbelievable 150%, quarter over quarter. Let that sink in. Not year over year, but just in 3 months. That business is now a multi-billion-dollar segment of AWS. This is the insight that proves Amazon isn't just participating. They are executing a brilliant stealth takeover of a critical part of the market. While others were marketing all-in-one AI solutions, Amazon was perfecting the art of being the ultimate AI landlord and hardware store. Let's use another analogy. If Microsoft's Azure is offering a beautiful, fully furnished luxury home with OpenAI tech built in, AWS is playing a different game. They are providing the best foundation, their cloud infrastructure, and more importantly, renting out the most advanced specialized power tools, their custom Trainium chips, for companies that want to build their own custom AI house. And this strategy is brilliant. Amazon realized that not every company wants an off-the-shelf AI. Advanced AI companies like Anthropic want maximum control and the best price performance for their massive training jobs. And Amazon is delivering. Anthropic is using a massive cluster of Trainium 2 chips, scaling to over 1 million this year, to train its next generation Claude models, reportedly because they offer a 30 to 40% better price to performance ratio. What Amazon is doing is becoming the neutral Switzerland of the AI hardware wars. They have a deep partnership with NVIDIA, but they're also providing their own powerful, cost-effective alternative with Trainium. This gives customers choice. Everyone was so focused on the flashy AI models that they missed the explosion happening one layer deeper. AWS revenue re-accelerated to 20% growth, hitting over $33 billion for the quarter. Their strategy is clearly working. They're making money off AI infrastructure as fast as it comes online. And they're not stopping. The next generation Trainium 3 is expected in early 2026 and will offer another 40% performance boost. So here's the bottom line. While the narrative was that Amazon was playing catch up, the reality is they were quietly building one of the most powerful and fastest growing AI businesses on the planet. They aren't just a cloud provider anymore. They're a custom silicon powerhouse, renting out the picks and shovels of the AI gold rush at a scale no one saw coming. If you stayed with me this far, now you see the real pattern. From AMD's rise to Google's reversal, from Microsoft's bottlenecks to Meta's build-out, each piece connects. But the real story is what happens when all of them collide. Okay, so let's zoom out and connect all these dots. Because when you line up AMD's rise, Google's resilience, Microsoft's strain, Meta's overbuild, and Amazon's stealth takeover, a much bigger story emerges. Individually, each company revealed a different angle of the AI economy. Together, they expose a single truth. The AI boom has crossed the tipping point. It's no longer a software story. It's a capital story. AMD shows that AI demand is diversifying. Google shows that AI monetization works. Microsoft shows that AI scaling hurts. Meta shows that AI infrastructure is now a macro investment category. And Amazon shows that AI hardware is becoming the new monetized service layer, basically the new cloud. When all of these collide, the picture is unmistakable. AI has become the new industrial revolution, one not built on steam or steel, but on silicon and power. We are witnessing the birth of a new economic layer, a global infrastructure race where compute, data, and power capacity are the new oil pipelines and refineries. Every earnings call now feeds into that same equation. Who can build, connect, and monetize intelligence the fastest? And that's the hidden signal this earnings season just confirmed. The AI economy isn't cyclical anymore, it's structural. The players aren't chasing hype, they're underwriting the next phase of human productivity. So when all five stories collide, they reveal one mega trend. The AI build-out is no longer about who wins next quarter. It's about who owns the infrastructure for the next decade. Finally, I got one more biggie for you. The elephant in the data center, so to say. Mark your calendar for November 19, 2025. That's when NVIDIA is set to report its Q3 earnings. Given all the signals we just unpacked, NVIDIA's report isn't just a standalone moment. It's the crossroads of the entire AI build-out. If NVIDIA delivers strong growth and raises guidance, which I personally strongly expect, it will burn a trail through the noise and validate the narrative we've built across all these 5 companies I just mentioned. Before your dopamine-starved brain jumps to the next clickbait though, let me know your thoughts. Will all this spending lead to an AI build-out hangover, or will the boom just keep compounding? What's the one AI trend you're watching most closely? Let me know in the comments below. And if you want to keep getting analysis that goes beyond the headlines, make sure you're subscribed with notifications on. Nothing here has been financial advice, of course, just sparks from the forge. Always remember, the market's the forge and your research is the hammer. Thanks for watching and see you in the forge.